some nonsensical actions. The one that's certainly changed a lot recently in the technology world is valuing a company based on the number of patents they hold. And so one metric, the metric used to be, not used to be, a rule of thumb was your company was worth $1.5 million times each patent you owned. When Google bought the Motorola portfolio, they valued it at $6 million per patent. So these are different types of comparables. Well, if you're a patent-heavy company and you saw that Google just bought Motorola for 6 million times patents, you look at all the patents you have and go, all right, I got 2 patents, well, it's worth 12 million bucks. That's what I mean by a comparable. And so what this means to you, if you're running a business, is you're going to want to keep an eye on deals that are occurring and keep track of them. And usually the rule of thumb is you don't look at a deal more than 5 years old or the deal that happened before some sort of economic turmoil. So in 2008 we had a recession. Essentially at that point forward you couldn't look at deals before that recession. So that's the way to think about it. If you can find privately traded deals, these are deals that private investors do, or publicly traded deals, so ones that are on a stock exchange like NASDAQ or the New York Stock Exchange, that's where you really would like to go to look for comparable. So and it's never just one. You ultimately have a small list. I don't know if there's a magic number on the list, but the more you have on it, because then you can start to see trends and see averages and things like that. All right, so any questions on comparables and ratios? So that's the 3 legs of our stool. So if anybody ever says to you, how do you value a business? You go, well, let me tell you. I got a stool. I got asset value, I got discount cash flow, and I got comparables. And for me to find a true asset value of a business, I'm going to look at all 3, and that's going to tell me where this business should lie. Where it typically doesn't lie, and I do see it sometimes, is when you have a seller who says things like, here's the number I need to see, or this is what will get me out of debt. All these things are quite frankly irrelevant. They may impact the decision for them whether they buy or sell, but it's not a driver for the value of the business. All right, so let me talk about one other one that you guys may see that I caution people against using for anything more than a perfunctory look at a business. And that's what we call an EBITDA multiple. So let me explain what an EBITDA multiple is, because this is a bit of business speak. So the terminology revenue, we often call this top line. This is all sales, just sales with nothing subtracted out. And then earnings would be all sales minus all expenses. So that's your earnings. Well, there's this thing called EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. It's an accounting term. And it's an accounting term that only looks at certain types of expenses, not all of them. So you may have unusual expenses such as, I don't know, let's say you got sued for a slip and fall. That wouldn't show up in your EBITDA, but it would show up in your earnings. Does that make sense? And so the reason we use EBITDA, it's a better way to normalize returns for unusual events. And so when we say this term EBITDA multiples, we say, let's look at different businesses' EBITDA, the earnings before depreciation, interest, taxes, depreciation, and amortization. Then I can normalize and look at a trend. And so then what you have are, depending on the industry, there will be these EBITDA multiple trends. So you can say, here's my company's EBITDA. What industry am I in? When I'm looking at buying or selling a business, is my price within the window? And so here's some examples. This is by no means an exhaustive list. There's a whole world of this stuff. So what industry you're in would have a different multiple. But you can see some examples here. So on the really low end is retail. So retail tends to have low margins. So it's not uncommon that a retail business would sell for half times EBITDA. Half times EBITDA. Whereas on the flip side, software, on the low end, they sell for 6 times, and I think Google right now is trading at 30 times EBITDA. And so you do get some extreme examples. I think Tesla's traded at 100 times EBITDA. So you got some really bullish people, and you say, how does that happen? The reason Tesla's going to be trading at a 30 times or 100 times EBITDA is probably driven by their discount cash flow. Their discount cash flow. They're saying Tesla's going to be really big a few years out, so it's going to be worth it. And that's why I caution against people using this to actually value a business. It's just a good way to ballpark things. Get you in the neighborhood, find out what your business is, and it'll help you if you're looking around for what can I possibly sell for, or what can I possibly buy, this will give you some indicators of that. Because if anybody's using even the most basic software for accounting like QuickBooks, it'll spit out an EBITDA number to you. So this is something that most business owners are going to have at the ready. It'll give you an idea of what you may sell for. So I think it's straightforward. Manufacturing, 3 to 5 times EBITDA. An operating doctor's office may sell for 1 to 2 times EBITDA. So I know this is actually one of my shorter talks because I know this is some pretty dense material. So that's all the material I have for tonight. I didn't want to get too much into the weeds. I know we have a big group here, but maybe this is a good opportunity for us to have 2 other conversations. But so before I leave valuations, any questions about any of these or the methodology? Okay. So
let me ask a quick question.
Yeah.
If you don't know what your company is worth and you don't know how to do this, are all 3 of those legs of the stool available publicly so that companies can compare and get their valuation of their company?
Well, these techniques are pretty well known. So these aren't some secret thing I came up with. So this is an industry common thing way for valuing a business. And so there is some homework you have to do. So if you want to figure out your asset value, you're going to have to do this work to figure out what all your stuff is worth. If you're going to use this, you're going to have to build a spreadsheet that makes these calculations work. And if you're going to use this method, you got to go out there and find out what these other businesses are worth. And so using the Wall Street Journal and other tools, you can track this stuff. This one more than any others is the hardest to track because you're oftentimes relying on company announcements.
Okay.
So I encourage people who are thinking about selling or buying a business to start looking at trends over a long period of time. So when I was running a business, I would look at my near competitors, deals they were doing, and track transactions on a spreadsheet. And over time, that got to be hundreds of transactions, but when I started out, I only had a few. If I wasn't tracking over a couple of years, I wouldn't have those. And then it gave me a really strong leg to stand on when I went to investors and said, here's what I think our business is worth based on comparables. So yeah, there is some legwork here. So I'm not saying it's trivial, but it's doable. And what this does is it allows you to come into a pricing discussion with some data versus opinion. You will meet people who say, I don't know, any business worth less than $500, doing less than $500 in sales is only worth $500,000. That's not really a technique. That's just that's really a bargaining positioning. So you want to differentiate the two. Good question. Sir.
Other thing, not question, just wanted to point out, especially if you're dealing with closely held businesses, you need to do a little bit more investigation because there's a lot of times when there's a lot of stuff hidden in there, especially in terms of your earnings. There's going to be a lot of inflation of, possibly inflation of inventory values and things like this as a means to hide, for tax purposes, for hiding revenues.
That's a very good point. So if you're buying a company, don't always trust the other guy's accounting numbers.
Absolutely not.
I've seen all kinds of shenanigans.
Yeah, don't trust their tax returns either.
Yeah, you want to have your own accountant look at the numbers, have your own accountant come up with these numbers. An extension of what you're discussing about over discounting things, particularly in owner-operated businesses, you often see a lot of mixing of personal expenses with business expenses, and that's a no-no. And figuring out, so you've got to be working with quality information in for these techniques to work.
Yeah, 100%.
Yeah. So if it's garbage in, you're going to get nonsense.
Yeah.
So.
I was just wondering what happens if one of the legs of the stool is considerably shorter than the others.
Yeah.
Like a business like asset value versus the other two. If it's running on antiquated, equipment and such that's hard to put a significant value on yet turning a good profit, how does that all come out in the wash?
So this one tends to be the biggest outlier. And so I'll give you the extreme example to be a software company. So if you were to take a software company and look at all of its assets, it's probably a handful of computers. And computers depreciate very quickly. So a 2-year-old computer on the market might be completely worthless. So you may look at a software company, they have this great software, they have all these users, their asset value is virtually zero because they're all running on 2-year-old computers. That's an example where this is the Lego stool that if it doesn't stand up, it's usually this one. And so you want to look at industry norms more relevant. So if you found a company, you say, well, when we look at other software companies, they all have really low asset values. That's the norm. You know, I would actually worry about a software company that had a really high asset value. Because the flip side is, I mean, I know software companies that rent everything. So their actual asset value is virtually zero. I mean, if you guys are familiar with Amazon Web Services, there was a time 10 years ago when you actually wanted to have your own computers that run their software on the internet. Now it makes more sense to rent time on Amazon's computers and not even own the computer. So that brings your asset value even more, but it's a good way to run the business. So this is the one that's usually the outlier.
Yeah, the other thing to point out about, in terms of asset values is, again, it was mentioned, but to reiterate, do not just take book value minus depreciation, because sometimes there can be significant differences. One particular case that I'm very familiar with are stainless steel wine tanks, because a wine tank is equipment, so it's depreciated after 7 years, but it's basically at that point still market value, marketable on the outside. Stainless steel does not go down.
All right, real estate is another one that doesn't depreciate. Well, the land, maybe the house property won't, but the land typically doesn't. And then there's some things that will depreciate and then appreciate, such as classic automobiles. So for the first 20 years they depreciate, and then for some reason they start becoming collector's items and go in the opposite direction. So yeah.
But the book value still shows the thing is worthless. The books are not going to carry that as any value, even though it's appreciated. So
so you have to be honest about how you price it. Right, so if I had an old car, I'd probably depreciate it down to virtually zero, but it turned out it could be a collector's item.
So what about client lists? You're a service company and you have this number of clients that you've been dealing with years.
Yeah, so client lists are often baked into something like this. So I've seen people do calculations on the value of a client list. It's also, could be a comparable. So if you look at a similar company, maybe you could choose to value it based on client list. Law firms do a lot of this.
Law firm even.
Yeah, so law firms will do that with their client list, particularly.
I don't know a law firm, but I got another.
But it also depends on the type of law firm they are.
Yeah.
So for example, law firms that do a lot of personal injury, the client list isn't as valuable because it's not a recurring customer. Whereas a law firm doing corporate law, there's a lot of recurring revenue there. Okay. So, before we do open mic, what do you guys want to talk about next month? It's December. I don't know if there's a holiday theme or anything.
financing Christmas presents.
Financing. I could do a talk on why gift giving is bad for the economy, but that's more macroeconomics. Yeah, so gift giving is horribly inefficient. Like if we were to make good economic sense and make good economic decisions, nobody would ever give a gift to somebody else.
I think I can use you as justification.
Let me rephrase it. It's not gift giving, it's anonymous gift giving. So if Alan tells me what he wants and I get it for him, that's efficient. If I try to guess what he wants.
No, that's Spencer.
Yes. Right. You may tell by Alan's voice that if I were to give him a cricket racket, he might like it, but a baseball.
Kilt would be better.
There you go. So if he were to give me a set of bagpipes, that would not be a good, an efficient gift. So there's a lot of inefficiency in gift giving. Could talk about that. We'll help you move the business along. We'll certainly have a fun conversation while you can go back to your family and tell them why you didn't give them gifts.
Any questions?
Yeah, by extension, why you should never give gift cards. 20% of them never redeemed. So when you see Applebee's offering you a $25 gift card for $20, it's just break even for them. They're just pumping up their revenue, and now you can see why. It's a push for them. Cool. Any topics, any ideas, something on people's mind? Something current, something?
Can you tell me how to get a hold of Mr. Bauer, the energy?
Oh, yeah.
I don't have anything to write on.
You can take a picture of that or whatever you want to do. I give you my business card.
Yeah.
Okay. Anybody want? Let's see. Brian's about to announce the winner. So this clean energy program he runs. They're about to. It was a competitive program. 76 West first prize is $1 million. One of the caveats for you to collect that $1 million is your business has to operate in the southern tier region of New York State. So we're trying to grow a clean energy, green energy hub here, and so far indications are it's moving in the right direction. Any other thoughts on next time? No? Okay, well if you guys think of any, feel free to contact me. We'll chat around. So let's do open mic. And I'm curious to hear who else is in the room. We don't have a mic, so if you want to just stand up, introduce yourself. Maybe I'll put Alan on the spot. Alan, would you like to introduce yourself and tell everyone what you're up to?
Okay, Alan Ray, Incubator Works in Corning and Alfred. I'm excited because this week I'm talking to 2 clean energy businesses from out of state that are looking to come into our incubator and set up in the southern tier. And that's pretty exciting.
And were those 2 related to the 76 West initiative?
Totally unrelated, but one of the companies that didn't make the semifinals of 76 West has actually set up a subsidiary at Stony Brook.
Okay.
And so, yes, it has actually attracted businesses to the state.
I love it.
Yep.
Thank you. Would you like to? Anybody newly wants to introduce themselves to the group?
Yeah, I'll go.
All right.
I work for Scope, doing economic and community development, and we work with Brad to create this event. So that's just a little bit about me. I think these are good things for our community. We don't always have talks like this for our community, so it's kind of cool to have these things, especially bring them to our area. Kind of reminds me a little bit of me when I went to my master's, when I did my MBA, some of this stuff. So it's to bring back good and bad memories of working on that, doing those math problems. But yeah, this is interesting, and my only thought and question is that people that get into this and have never valued their business before, or have a business and say, okay, I want to sell it. My understanding of that would be a lot of people would not know where to even start with this process, and I guess this is a good thing to it's a good starting place to value a business before you sell it or buy it.
Yeah, and really my point here was not to turn you all into experts, but to let you know there is a method. This is not magic. And then if you find yourself in a more specific situation, I'm happy to help you. So I'm helping a company right now. Actually, I'm working on 2 deals right now that are a flavor of this, and they're putting evaluation. One is one of our member companies is acquiring another company, and they're doing a straight asset value sale. Whereas another one, there's principal suppliers so excited about their business, the supplier's investing, and they're going to invest in kind, and so we wanted to figure out the value of that. We're primarily using the comparables and discounted cash flow to work out that. Yeah, so I'm happy to help you if you come into specific instances. Anybody else? No?
My name's Steve Logston. I'm from the great city of Brooktondale. We don't have any stoplights. I have seen a state trooper once in a while. But I do a lot of things. One of the things I primarily do, I pastor a church in Ithaca, but because my 4 houses and 7 television shows, I just needed something else different. Thanks, Brad. You're the only one who got the joke. Preachers are broke. But one of the things I do is I do small group, small business, and church seminars to teach personal finance. I do that at no cost. And the next question, well, how do you make money if it's no cost? But I can go into that later. Actually, it's really not something I would do in my open mic. But what I do then is to teach people in the businesses personal development and personal finance, how to save for the future, how to spend, how to take a picture of everything's going on in their personal finance, and then make recommendations. If it's broke, we help them fix it. If it's not broke, we tell them not to break it. And so we basically become the personal finance coach that will teach people and businesses how to do that personally, to benefit and to succeed financially.
Nice. Thank you. All right, well, I won't won't keep you guys. I encourage you to meet the other folks in the room, particularly the folks who haven't been